Welcome everyone to Vested Interest. This is Shane back again for another stock pick of the day video. It is March 18th. We're going to take a look at Abbott Laboratories. This one is out of the healthcare sector. Let's jump right in the video. And if you are new to the channel or would just like to help me out, if you could hit that thumbs up down below if you find any value in the content, hit the subscribe button, join us on this journey to financial freedom, join the Vested Interest community, hit that notification bell so you're notified whenever we put out any new content. Don't forget to drop a comment down below. Let me know what you think of the video. Is Abbott Laboratories in your portfolio? Is it one you're watching? Is it one you're avoiding? Or is it one you're maybe selling that you've had and maybe taking some profits right now? So now that we've got that out of the way, really do appreciate all of you who have taken the time to do that, and really appreciate those who have subscribed to the channel. You guys are awesome. Thank you for being a part of the Vested Interest community. Now, this is the Vested Interest Stock Screener. This is how I look at a company on a high level. It's also how I run through these videos. So you can pause this, run through this criteria, but this is exactly what we're going to cover here. Now, I will say, just because it may meet the 5 of 8 or 6 of 9 if it's a financial company, I like to use price of book for financial companies, with 1 being fair value, anything under 1 being undervalued, anything over 1 being overvalued. That does apply price to book for other companies, but make sure you are comparing it to other companies in their sector if it's outside of the financial sector like banks. And like I said, just because it meets 5 of 8 or 6 of 9 doesn't mean I'm investing in it. It just means that I'm interested. It goes on my watch list. I do more of a deep dive into the financials of the company, set a price I'm willing to pay, and then wait for it to hit that price. Now back to Abbott. If you want to know more about this company, check them out at www.abbott.com. That's www.abbott.com. That is their homepage where I pulled this information from. Creating life-changing technology, from removing the regular pain of finger sticks as people manage their diabetes, to connecting patients to doctors with real-time information monitoring their hearts, from easing chronic pain and movement disorders to testing half of the world's blood donations to ensure a healthy supply. Our purpose is to make the world a better place by bringing life-changing health technologies to the people who need them. That's our commitment to helping you live your best life. Right? They're a healthcare company. That's what they do. And some of their life-changing technologies you can see here: cardiovascular care, keeping your heart healthy with the medical technologies that help you and your doctor better manage your health; diabetes care, diagnostics, providing the information you need when you need it so you and your doctor can make better decisions; neuromodulation care, treating chronic pain and movement disorders by targeting specific areas of the spinal cord and brain; nutrition, nourishing and supporting your health at every stage of life; and branded generic medicines, right? Your prescriptions at the pharmacy. They provide a lot of the prescriptions that you may buy and need, especially for those of us as we start to age. Might be more and more of those. You know, my mom and dad and my grandparents passed away, but they were on quite a few pills there right at the end. So they're a healthcare company. That's what they do. Holistic healthcare company. Now on to the reason we were taking a look at them. Down 2.64% on the day. Closed out the day at $112.44. We are talking about Abbott Laboratories, ticker ABT, out of the healthcare sector. 52-week range as low as $89.67, as high as $121.64. They are leaning closer to their 52-week high than their 52-week low. Average volume 5.1 million. Today's was 10.2, so you can see that sell off throughout the day here, right? Just a nice steady decline overall. Looks like they popped slightly in the morning, but overall from about, what is that, 9 o'clock on, 9:30 on, just a straight drop off, just sliding downhill there. Market cap of $195.112 billion, a beta of 0.74, so they are less volatile than the overall market. That's what beta is. That's a volatility of the market. 1 being the market, under 1 being undervalued, over 1 being overvalued. Price to earnings ratio, $34.49 per share. That is a little elevated in my opinion. EPS, earnings per share, sitting at $3.26. Next earnings date is coming up between April 17th to April 22nd. Forward dividend yield is $2.20 annually. So divide by 4, or just give us a little bit of time. We'll cover that here in a minute. Dividend yield at 1.9%. A little lower than I like. I really like companies in the 2% range with nice growing dividends. But if dividends are growing fast enough and it's undervalued, I don't mind dipping below that. But it's got to be really growing fast. And we'll see if they are here in a little bit. Ex-dividend date, April 12th, so coming up here next month. Looks like they are going to pay, I don't know why I put split factors over here, but I did this time. Looks like they're going to pay out in May. Yeah, May 15th. And a 1-year target estimate, at least according to Yahoo Finance, where I pulled this information from, $125.74. So they do see some upside with it setting a new 52-week high. Previous 52-week high would have been 121.64. Now, I like to get into the statistics, look at dividend yield theory. To do that, we're going to look at the 5-year dividend yield average of 1.58%. We compare it to its current 1.9, or over here, forward 1.9%. Same number, and if it is higher, which it is, that speaks to some undervaluation. Now, not a lot. It's pretty close, right? 5-year average of 1.5, current 1.9. I would want a little bit more of a pullback here, back towards its 52-week low. Maybe something under, like 100, 110, maybe 100. I haven't done a discounted cash flow analysis on this one, so you should probably do that if you're interested, so you can understand what you're willing to pay. But in my mind, if you could get this above 2%, that would give you a bit more of a margin of safety. Payout ratio is under the 75% that I like. Again, we looked at the ex-dividend date, and the payout dividend date is in May. Now, we're going to get into financials a little bit and look at free cash flow, but in the financials tab, you're going to find a lot of good information. Their balance sheet, their debt to equity statements, their balance sheet, their income statement, their assets over liabilities. Are they paying down debt? Is their revenue growing? Are their margins expanding or contracting? Lot of good information down in that tab, on the financials tab. Make sure you're looking at that and understanding, because that's where you find out about the fundamentals of the business. Now, if you're not willing to look at that and understand the fundamentals of a business, not a building, of a business, you should probably be buying index funds or ETFs and stay away from individual stocks. You really want to understand a stock. Don't just buy a stock without understanding the financials. For our purposes, we're going to look at free cash flow. We want growing free cash flow over time, because typically if you have growing free cash flow, you have growing dividends, and dividends are paid out of free cash flow. So that's why it's important, right? That payout ratio is telling you that only 62.58% of their free cash flow is going to the dividends. That means the rest of the cash is going back into the business, reinvesting back into the business, buying back shares, doing acquisitions, those sort of things, right? So we want to make sure. That's why I set a limit of 75% or more. I don't want any more than 75% of the free cash flow going to dividends, because that gives them a little bit of buffer, like I said, to pay down debt, reinvest back into the company, make acquisitions, those sort of things. Unless it's a REIT or a limited partnership or some of the other companies that by law are required to pay out more than 75% in dividends. Now, going back to 2020, we're looking at free cash flow here at $5.7 billion. 2021 up to 8.6. 2022 a little bit of a drop to 7.8. 2023 a further drop to 5.5 billion here. So overall, it does look like free cash flow is, we'll call it flat, because if you look at this next stage up here, repurchase of capital stock, they're repurchasing shares, only 403,000 that year in 2020. 2021, big jump up. So they had a great year in 2021. This is probably the COVID stuff here, maybe a little bit of 2022, 2.2 million in buybacks, 3.7. So 2022, you can account for the drop from 2021 in the repurchase of shares, but you definitely can't account for it in 2023. So what it looks like is probably maybe a temporary bump from this COVID, and then back down to where it should be normal. Because if you look at 2023 to 2020 numbers, you could adjust for that decrease with the repurchase of shares. So I like that they're repurchasing shares. I don't like that their free cash flow is flat. I'd like to see a little bit more growth in this one, and it does kind of look like the trend from 2021 to 2023 is negative. So that's not good to see, but I'd have to do more research, because these companies are capital intensive. They're always doing a lot of R&D, research and development. Sometimes they're making acquisitions and buying out smaller companies. So there may be some of that going on here from 2021 to 2023 as well. So you need to look at what they're doing, look at their pipeline of drugs. Do they have some in the experimental phase? Do they have some in the approval phase? Do they have some that are going to hit the market relatively soon? So you'd want to understand all of that as well. Now we're going to jump over to stockanalysis.com, take a look at some other numbers. I recommend stockanalysis.com and Yahoo Finance. Those are the two that I like. You pick any sources that you like. Just make sure you're not picking just one and blindly believing whatever they tell you. Make sure you're picking 2, if not 3 sources, so you can make sure the information you're getting is accurate and up to date. Now they have 11 analysts that have taken a look at this. They call it a consensus buy. Again, I don't necessarily agree with that. I definitely like it closer to their low estimate of $107. That would be a 4.86% decrease from where it currently sits. Average estimate of $125.27. That's pretty close to what we saw from Yahoo Finance on the previous page. That would be an 11.39% increase from where it currently sits. And if it happened to hit their high of $141, that would be a 25.38% increase. All the while, you could collect that almost, but not quite 2% dividend yield. Again, I would like them back under 110. Maybe a little bit lower, but I have not done a discounted cash flow analysis. I just think that would put you into above 2% dividend yield, which would give me, in my mind, better margin of safety according to dividend yield theory. All right, so let's keep going. We're going to jump into the statistics here. We're going to look at return on equity and return on invested capital. I like 10% or better for these metrics. Return on equity for this one sitting at 15.1%, so beats the 10% I'm looking for there. Return on invested capital just over 10% at 10.40, so good numbers here for these. And again, companies like this are capital intensive, so I don't expect them to be knocking it out of the park like some other companies who have less capital intensive businesses. Like I said, they're constantly doing research and development. They're constantly trying to push out new drugs. They're constantly trying to make new developments in medical care, and that takes money, right? That takes capital. Now, these numbers are very good. For EPS growth, I typically like 5% or better growth. They're sitting at 17.76% projected over the next 5 years. Very good. And revenue growth, same thing. Very good number, 6.90. I don't have a metric for this, but I always like to include it just so you can make sure your revenue is growing over time. So 6.9%, very good number overall. Let's take a look at dividends and wrap this one up here. So quick look at the dividend here. Again, they are a quarterly payer. Payout ratio 67.48%. So again, under the 75% I look for. Nice dividend growth at 8.16. Again, going back in my mind, I think we saw a 34 PE on this one. That's a little high for only 8% dividend growth. And even though the EPS growth was at 17%, I believe, revenue growth of 6%, I need to look at this one a little bit better. I just feel like it needs to pull back further. The PE, price to earnings ratio, is pretty high. I'd want very fast earnings. You need to go look at that in their financial statement to see how fast earnings is growing, to see if it justifies such a high PE. That just seems pretty high for a company like this. All right, let's look at the dividend and wrap this one up here. 2021, April, they were paying 45 cents. January 2022, they raised it up to 47 cents. January 23, they raised it up to 51 cents. And most recent, January 24, they raised it up to 55 cents, and that's where it remains. That payout in May is going to be 55 cents, so that tells you what they pay per share per quarter. They are a quarterly payer here. Well, that's it for this one. Let me know what you think in the comment section below. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up. Ring the notification bell. Most importantly, hit the subscribe button. Join us on this journey to financial freedom. Join the vested interest community. It really does help a small YouTube channel like me grow. And drop a comment. Like I said, let me know what you think. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like Abbott Laboratories, drop it in the comment section. I'll try to work it in. I do not cover cigarette stocks, and I do not cover non-dividend paying stocks, so just keep that in mind. My dad was a smoker. He's on oxygen. I probably should do a video on that at some time. I'll show you a picture of his most recent incident here from December. But for me, that's part of the reason I don't do them. And nothing against people who smoke or drink or anything. I just don't do a lot of the sin stocks because that's, I just don't. Well, this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great week, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice of a certified financial advisor.